Hello and welcome to the Durham Talents channel. My name is Jesse Durham. I'm very excited about today's round table. We have two new guests to the round table. They're not new to the channel, and everybody on here has had a one-on-one interview style conversation with me. So I would encourage you to check out the backstory on all these titans in the space. Make sure to check that out at our interview series. We're going to have an unscripted conversation today. We're all looking forward to it, and I hope that you enjoy. Beautiful. So let's do this by way of reintroductions, because like I said, everybody has had an interview with me where people have heard everybody's origin story and they know who you are and how you found infinite banking. But Dan and Bruce, y'all are both here at the round table for the first time. So Dan, why don't you just give a quick hello to get us started this morning?
Yeah, hello everybody. The way I stumbled upon infinite banking, if you want to know real quick, was back in 2020. I was looking to buy a house in North Springfield, and I just happened to have a whole life insurance policy, and so I put it to work. I was going to withdraw and surrender the policy until I talked to the agent, and she said, "Do you want to take a policy loan?" And I was like, "Well, I'm not interested in loans, but I'll look this thing up." So I did some more research and I said, "Well, this is different from a bank loan." It seemed like, and so I was able to buy my house in North Springfield using a policy loan, and it was such a big blessing that I started telling everybody about it.
I love it. And you actually posted something on social this week that I got to see, with the house and the kids and everything. It's a really neat story. Again, if folks haven't heard Dan's introductory story, go there and listen to that. All right, I think you gave me a topic, Dan, that I might jump us in on, but let me continue. Let's go over to you, Bruce. If you would say good morning, anything quick that you just like to open up the conversation with.
Yeah, good morning. Yeah, I can actually, first of all, when Dan was talking about, he's talking about Springfield, Missouri. There's a lot of Springfields out there in the United States, so I want to make sure because it ties into what I'm about to say. Um, I also came into infinite banking, and as I told Nelson Nash, one of my mentors, I was doing infinite banking before it was cool. And Nelson used to laugh about that because I had a similar thing. I had a whole life policy that was given to me after I got married by my father, who took it out on me when I was married. And he said, "Son, you have money in here that you can use to put a down payment on your first home." And so that was my first experience with it. And it was such a wonderful experience. Within about 18 months later, I was approached by Franklin Life to actually present this to some of my former students and players as a teacher and a coach, as a way to store money. And making a very long story as short as possible, then Dan actually then reached out to me from our podcast, The Money Advantage, and we actually set him and his family up with several additional policies. But what the ironic thing is that one of Dan's life insurance agents from his first policies was actually one of my students and coaches from when I was a teacher. So it's amazing 360-degree story about how this all works.
Yeah.
That's so very cool. So wait, all right, this is going to be great. So thanks for the introductions, guys, and let's go with this topic. Let me give it to you. Let's talk about the difference, because there are so many voices out on social media and the interwebs right now saying so many different things. I'll actually personally share a video with y'all. I won't do it here and now, but somebody, in a 60-second reel saying some ridiculous things about what infinite banking is, what it isn't, the Nelson Nash Institute, just crazy stuff. But anyway, we have such a varied background here of experience with whole life insurance and the codified infinite banking concept that I think this is going to be a great conversation. All right, so let's field this idea of owning or even using whole life insurance versus implementing the infinite banking concept. So I'll give my background. Maybe y'all know this, but if you don't, let me give you a bit of my background. And again, I'm saying this knowing full well that Bruce, your podcast, Dan, you're putting out content, Brandon, you put out a great car purchase scenario the other day that you let me see. I love it. Everybody should check that out. Rob, you're putting out stuff all the time. So we're putting this idea out there. But again, so let me go back to when I got my teaching job in North Carolina. You know how it is. You get a new job, you're introduced to the human resources, and they provide you all the options and opportunities of government plans and all this other stuff, right? Well, that was the same year that my first son was born. So it really struck me, hey, I'm a young married man. I've got this job and there are these work benefits, and I was contributing in my 401k and stuff. And I wished I could remember anything specific that compelled me, but I decided to go get my own life insurance, not just the job stuff, right? So I know that it was because of my son being born, but I said, I'm going to go out and privately get me some. So I went to the box store agency, talked to my box store agent, and they said whatever they said, presented whatever they presented, and I decided on whole life paid up at 20. And I can tell you that I do remember liking, guaranteed death benefit, something that I would always have. This wasn't going to be a fleeting thing, right? Because again, I wanted to personally own this kind of protection, young family man now. I liked it when they conveyed that it would have a cash value, right? And I even liked the idea of, but I'll do this for 20 years and I'll be done. So those are really the only things that I remember, as far as attributes or characteristics go. So I intentionally bought whole life insurance for everybody in the family. Policy on me, policy on my wife, policy on my son, right? And that was the plan. I was like, okay, as we keep having children, we'll get these kinds of policies on them. Didn't know anything about infinite banking. I wouldn't learn about infinite banking for another 2 years. So there are a lot of historical examples, right? The J.C. Penney's, the Miss Christopher's, who launched her Pampered Chef idea, the Walt Disney story, very famous. Ray Kroc, the McDonald's brothers, that buyout, and people have owned whole life insurance for a long, long time, and that's seen a real big swing, right? Where it's popular, normal, ordinary for people to own whole life insurance. And then there's some decades where it gets derided without merit, in my opinion, in my strong opinion. And then now, of course, it's being touted as the ideal asset for folks who do want to implement this codified infinite banking concept. So I know that's a long way. I'm just trying to give a robust kickoff to hand this off to y'all to say, let's talk about the differences of what it means to own whole life insurance, or even to use it. Bruce, you got a lot of experience using whole life insurance. Dan, you got experience using whole life. But that difference of implementing infinite banking.
Bruce, I want to hear what you have to say about the value of whole life and just having that separate from utilizing the process of infinite banking.
That's good.
Yeah. So, when you actually experienced it, which I did before it had a label of infinite banking, you view it from a different lens. You view it from a lens that it always made sense, and why wouldn't everybody do this? And so I have to in my educational process, a lot of times I have to step back and say, what is the listener actually feeling because of all the noise out there that is different than what I am just projecting? So I think infinite banking concept, by utilizing whole life, has done somewhat of a disservice. I'm not saying Nelson did a disservice, but I think the way it's been, I love the word codified, Jesse, in our sales process now. When I say our, I don't mean us on this call or even people in the infinite banking practitioner world. I'm talking about in the industry world, where people have just said, oh, look what you can do with this whole life insurance as a way to not even take the banking function in. It's simply a place to put money before you go invest it somewhere. That's where it's actually sliding down what I call a slippery slope, because all they're doing is saying, hey, look, I'm going to be able to sell this as a way just to park your money for a short period of time to go then invest it. so that you get a rate of return in two places. And that is not what the original concept or even the original intention of people putting money into whole life was. It was actually a place that provided you a variety of benefits. Number one, Jesse, I think I love working with people that see the value of a guaranteed permanent death benefit. And when I say guaranteed, what I mean is guaranteed by the fact that as long as you pay the guaranteed premiums that are not going to go up, because other permanent life insurance, so-called permanent life insurance, it's only permanent if you can continue to pay the premiums that are not guaranteed to stay at the same level. They can go up. Okay, so there's a difference in permanent as far as guaranteed premium, and permanent as long as you pay the premium that could go up. So they forget about that death benefit being really, really important. Number two, they forget that the guarantees of the policy are very, very strong when you look at the entire way it fits into your portfolio of assets. And they almost say, oh yeah, and it has a guarantee. But we don't even worry about the guarantee because we're going to not leave it in there. We're going to borrow against it and go do something else with it. And actually, frankly, they don't even say borrow against it. They bastardize and say we're going to take it out and we're going to take it somewhere else. And then the other thing is that to use it as a place to grow your assets tax-free is very powerful. But people don't even talk about that. The modified endowment contract came along because Congress said, now, wait a minute. We are not making this tax-free because we want you to have a tax-free investment. We want it to be tax-free because we're trying to encourage you to take care of your family with the death benefit. That's the whole reason the whole modified endowment contract came around, because they said, if you're going to treat this like an investment, then we're going to make it taxable. If you're going to treat it like life insurance, and in order to treat it like life insurance, now we're going to have to put some rules in. One, you can only put so much in per year, determined by how much death benefit is. Two, we're also going to look at your behavior over a 7-year period. So what are you putting in over 7 years, according to how big the death benefit is? And three, if you change the contract, you make a material change to the contract to try to manipulate this, we're going to look at that and see how it relates to the proportion to the death benefit. And if you violate any of those three rules, we're going to call it an investment. And now you're going to have to pay taxes on it, because this is not what we were trying to do with the American people. Remember, the tax code is put in place by Congress. Any tax code is put in place by Congress to actually influence the decision makers of the United States. They're trying to get you to work in the way that they want it to be worked. Now, we can argue about whether that's good or not, okay? But they're putting it in as incentives to manipulate the behavior of the American people. In this way, I tend to agree with it, because they're putting emphasis on the death benefit to take care of families. Now, they have a motivation, and I'll finish up right here. They have a motivation is because if you can take care of your family, then if you die, your family doesn't rely on the state to actually take care of them. So that is the whole premise of why they make death benefits, the growth within it, tax-free. So I just wish people would get back to the original reason that whole life was put in place as a insurance product for the death benefit. Nelson Nash then came along and said, oh, you can now use it as an alternative to banks, because he did not like what the Federal Reserve was doing to people. So I'll stop there, and we can continue with other comments.
I want to hear from these fellas, but I'll be the first to say that I certainly view that MEC issue as government interference with private contracting. But I can at the same time appreciate what you're saying of, bar any governmental influence, it's worthwhile to have guaranteed protection. So let's keep going with that. I love that you brought it up, Dan. Whole life and its merits, even before owning it with the intention of infinite banking, because I believe it has its own legs to stand on, and it has stood on those legs for a long time. So run with your thought.
Real quick, I read an article yesterday called The Economic Value of Certainty. I think it was Rachel Marshall actually that brought it up in an episode recently, but I went and looked at the article. It's only 5 or 6 pages by Les McGuire. It's really excellent, but he goes through and really breaks down what's seen and what's unseen, and the unseen costs or the unseen value of having whole life insurance and the guarantees that exist within the whole life insurance contract are are really valuable. And so if you don't have those guarantees, people tend to kind of, well, we'll wait and see approach to life. But when you have like certain guarantees inside of a contract like that, you will do things that you wouldn't normally do. Like you're more productive in life having certainty. And so it's a great article. I'd really recommend it.
Beautiful.
I've often made this comment, certainty is security. So every one of your listeners can actually put themselves in this position. If certainty wasn't valuable, then all you have to do is cancel your car insurance and then drive across town in traffic and see how you feel differently emotionally. Because you don't have that certainty that if something happened to you, you wouldn't be ruined financially. So I want everybody to think about that, your listeners. So if certainty is not that important, then cancel your car insurance and drive across town and see just how emotionally you feel.
Yeah, you're making me think of the time I jumped into a pool. First trip my family made down to Mexico. Brand new cell phone, because I wanted to take pictures on this trip, right? Got me a brand new cell phone. Jumped right in the pool as soon as we got there. Realized I had that phone in my pocket. Thankfully, I bought this nice, beautiful, waterproof, protective, emphasis on protective case, right? But I still had that initial impulse, oh my goodness, my phone's in my pocket, because I felt the weight of it. Yeah, the certainty of protection is super strong.
Yeah. Any other thoughts there? Go
I was
ahead.
going to say, I'll jump in from maybe a different perspective. My experience with whole life is quite a bit different than what you guys have mentioned, where I had come from more of the traditional type financial background of 401ks, investing, that sort of thing, and kind of bought into that buy term, invest the difference mindset. And one of the things that I think I found going through that entire process is a lot of that mentality comes from this whole price versus cost type mindset. And that, oh, well, I look at it and the price is higher. Well, yeah, that's expected, especially once you learn and understand more about what insurance really is. Well, if something's only covering you for 10 to 30 years, well, yeah, it's going to be quote unquote less money. But the reality is, with a whole life contract, like you guys were just talking about, I mean, it's going to pay out. So it should cost more, at least in terms of the premiums, but those premiums never increase. So if I'm getting a policy and I'm 25 years old, goes out till I'm 55, now what? Chances are, in the reality, I was just looking at average 401k balances for people, and there's no way that money is going to be enough to supply or insure yourself, as some of the individuals out there like to say. You're still going to need death benefit. So if I still need that, and now I have to do it at age 55, well, what was actually more expensive? Well, clearly the term insurance is going to end up being a lot more at age 55 than what it was at 25. But where I'm kind of bringing this back to is that whole entire mindset that I was in was influencing my perception of cost, that perception of price, and I wasn't looking at that big picture. And then I even sold insurance for a while years ago before I was relicensed and got into infinite banking professionally. But at that time I was like, well, it has these benefits. Why wouldn't someone do it? It's kind of like what was going through my head. And then you see these, I think the average person gets stuck in this mindset of, oh, bigger number, better, less money. So they get stuck there, and as opposed to seeing what the real value is. And that's the biggest problem that I think most people have when they hear whole life. And then you have all this noise, as we've been talking about, telling them, well, you have to have your money someplace that's, going to outpace the market and all these other things. And if we would just take a step back and really understand the basics of money, of value, and then start to reapproach our situation, we get into a better understanding of where this product really fits in. And I think what's really changed my mindset and my view has been how it's been used even in my own family situation, where, we've been able to actually use it the way Nelson talked about as a banking system. And it's been just phenomenal what's happened in the short time, 3 years that we've been doing it. It's unbelievable. And the level of certainty and security that we now have, it allows me to go think about, well, maybe I can go do this. It opens up your entire horizon to what is possible. And you can just go out there and do things, where in the past it was like, well, I don't know if I can do that. So, I mean, there's a lot there. There's a lot of different things that kind of weigh into that, your mindset, any one of those is its own topic, but I think the biggest challenge that I see for a lot of people in the space today is being able to separate themselves from that noise and just think. And I think that's a great part about what we do, all of us professionally, is get people to think differently. And once your thinking changes, then everything starts to look different. And I think that's where the real wisdom is in which Nelson did a phenomenal job of getting us to think differently. And once that happens, like I said, that horizon goes from being real small, really dim, to really large. And we have a whole different look and view on life.
Let me prompt y'all with something then that you inspired me to, Rob, because when people are turned on towards whole life insurance, I feel like it is with different mindsets, or it is with different perspectives. So let's just maybe kind of run through some of the perspectives that people are already thinking about or already hold, that's their belief, that's their current view. But then also as they come online to get more educated about whole life insurance and or infinite banking, they might think that, well, okay, whole life insurance could be a better place to have an emergency fund. I think that that's how it's portrayed by a lot of people in a lot of ways. Another one could be, well, okay, if you are that traditional investor, maybe you would use some kind of permanent life insurance, because that wouldn't necessarily always be whole life insurance. I had something happen the other day, guys. I had somebody specifically, and it was from a referral. So thankfully, I feel good that it wasn't necessarily just from my organic messaging personally to the world, but I had somebody specifically come from a referral who wanted variable life insurance. And that just, I've never had somebody saying, I want variable, and here's why I want it. Anyway, interesting. But some people are looking at permanent types of life insurances for maybe bond alternatives, right? So I'm just trying to name a couple, and I want y'all to name some and then address just that mindset like you're talking about, Rob.
Well, because I'm in the investment world too, talking about it being as fixed income or bond alternative does have some merits in my way of thinking, and I'll tell you why. When you look at fixed income or a bond, everybody thinks is safe because it's backed, especially a treasury bond, it's backed by the full faith of the United States government. But what people don't understand is that it's backed by the taxing authority of the United States government. So it is true if you hold a bond to maturity that you can't lose any money on it. However, the government, in order to pay for that bond when it becomes mature, if they don't have enough money and they're running a deficit, they have to just print more money, and they pay for it by selling more bonds. And so that just more money goes in the system. So you can't lose money. However, the money that the government is now paying you has actually been devalued. So you actually have lost money. So there's an inverse relationship to the value of the bond and the yield of the bond. So if it's a 10-year treasury bond that's paying, I'm just making these numbers up, 5%, then if bond yields go to 6%, then that bond value goes down, because why would a person buy your bond that's yielding 5% when they could go out in the open market and buy a brand new bond at 6%? So in order to get that 6% yield, you would have to sell your bond at a discount and lose money to buy the new 6% bond. And then you'd have to see what there's a break-even formula and so on and so forth. We won't get into that, but the conceptually, you can see that. So holding individual bonds is, for an individual, you can't lose money if you hold it to maturity, but you might be losing money because you could be making more money with the new higher yielding bonds. Okay. Now, life insurance companies, this is why having whole life insurance companies are anywhere between 75 and 85% in fixed income, bond or mortgage-backed securities that work very similar to that situation. So what ends up happening here is they don't have to sell the bond. Why? We have to sell it because we have only a certain amount of assets that we have, and we might have some cash flow coming in, but it's not that great compared to a life insurance company. So all life insurance company has to do is hold their bonds to maturity, not sell them to get the higher yielding bonds, because every month they have more money coming in in the form of premiums. So now they can hold the bonds, not sell them at a discount, and buy the higher bonds at a premium with new money. So now how's that translate to you using it as a fixed income or a alternative for your emergency fund or your opportunity fund? Well, now because they're making more money, guess what happens? They distribute it amongst the policyholders in the form of a greater dividend. So now suddenly, just because you had this whole life insurance contract, instead of holding your own individual bonds, you're going to benefit from the rising interest rate environment without having to sell your own bonds. So that's another alternative way to look at whole life insurance instead of just the infinite banking concept that has people used to, discourage people from putting money into this because they said it had a low rate of return. But the low rate of return can actually go up compared to a fixed income alternative such as a bond. If you look at Dr. Wade Pfau, PFAU, he did a white paper on this that actually shows that whole life, and he, by the way, is an RIA, registered investment advisor, analysis. So he wasn't even in the insurance world when he started doing his research on this. He was in the assets under management world and realized that assets under management could actually take greater risk in their stock portfolio, knowing that if they messed up, they could actually fill the bucket back up with the death benefit. And so it's a great paper to show that there's many, many benefits to using whole life insurance in your portfolio.
I agree. I agree that whole life insurance as a bond alternative or a superior place to build savings is all of that. But then, of course, and then some. And I do want us to eventually transition into that codified infinite banking concept. I had a follow-up question for you there, I think, Bruce.
I think Brandon, you were going to comment on something?
Yeah. Go ahead, fellas.
All of us are like, we got stuff at the tip of our tongue. Good morning, by the way. So I don't think I've been able to say that yet, but glad to be on here with you guys. So I'm going to back up a little bit to your first question, then I'm going to move forward because I think there's some relevant points to what you guys have just brought up too. But when I first had thought about life insurance over the years, decades, I always thought the two things that were in my head was it wasn't a risky place to spend my money, but it was a expensive thing to spend my money on, right? And that goes back to some of the stuff Rob mentioned, we've all kind of talked about, where buy term and invest the rest, right? So those were my initial thoughts. I never really understood this whole concept of a place to store money, a place to store an emergency fund, I didn't really understand. I knew that there was cash value, but I never looked at it hard enough to really understand what that meant, right? If I was investing money, I thought, my experience with the stock market was a little shaky, going through a couple of downturns. I didn't like that. And so I turned to kind of real assets, which is what led me to real estate, something that I could put my hands on, that I knew was always going to have value and generally always increases in value, a lot to do with the fact of the inflation piece that Bruce just mentioned as well. But life insurance as a whole, a conversation I had with someone just the other day when we were talking about this term piece and how it's so much less expensive. And I repeated to him what you guys said just a minute ago. It's guaranteed to pay a death benefit. And most people don't really sit and think about what that means. Like if I'm 65, 70, 75, 80, and the stock market just did a major downturn, and I didn't do a good job of making sure I de-risked myself prior to that happening because I'm super old, it just went out in value and I just lost all of my savings or the ability potentially to provide for my spouse if something happens to me, right? Which is the case for a 65-year-old friend of mine who's had multiple stents put in and major heart issues, and now he's uninsurable, and he's like, I don't have anything for my wife, right? So there is that. There is value in a death benefit, in whole life, in and of itself. Or the family just a couple of years ago of a boy in our community who was driving to school one morning, 17 years old, and comes around a blind corner in the rain and a concrete truck takes him out. If my son died unexpectedly or my daughter and they were a kid, my ability to produce an income for months would almost go to zero. There is a huge value in having a guaranteed death benefit that we just don't think about so many times, right? And one last piece that to kind of my impression of how expensive I thought life insurance was. Bruce and I were having this conversation the other day. As time goes on, and when you really understand cash value and that it is available for you to collateralize, right? You can access cash value tax-free. Then you realize that over time, your cash value compared, this line up here is your premiums that you've paid. This is your cash value building over time. Eventually, your cash value is going to catch up to your premium dollars that you paid in over time. And usually, most people are buying a 20 or a 30-year term. Usually, that cash value is going to equal that point before a 20 or 30-year term policy, right? And so at that point, now my cost of insurance that I thought was super expensive really is going to get to zero before that if I bought term and it was a 20-year term before that 20-year term expired, and now if I were to go in the term scenario, go buy more insurance, it's going to cost me a whole lot more money to get insurance because now I'm 20 years older. But now in the whole life piece, I have cash value greater than what I paid in premiums over that period of time, and I have access to it tax-free. So what does that insurance cost to me now? Like, it's really costing me nothing because I have access to the cash value that I can literally use for all the things you guys have talked about and many more, through this conversation and many others. But anyway, those are some big pieces that I think I was missing when I was thinking a tiny bit, not a whole lot, about whole life and the value that it brought to me.
I'm glad you said that last piece, especially, Brandon, because that's what I wanted to accentuate when Bruce was talking about, the company being profitable and having a dividend and us being able to enjoy that. But underneath that, there are these guarantees that, yes, you pay this level premium that eventually produces a cash value that surpasses premiums paid. So when we're talking about this inflationary environment, why would we not want to put dollars somewhere where we know guaranteed that percentage of our capital is going to be producing multiples of itself to some degree? And I don't want to get bogged down there, but still, I mean, if $1 can produce $2 in the future, or $5 in the future, or $10 in the future, because it can, right? And every policy is different, everybody's going to be different. But that's a great hedge against inflation. Even if somebody does only wrap their mind around a percentage of their cash flow to replace, as a bond alternative or savings or whatever. I actually had somebody, real smart guy, sitting down talking to me about financial stuff the other day, said, well, I would consider whole life insurance if I were a billionaire. And I don't think this person was flippantly throwing out that word, but that blew me away that somebody said, I mean, like, we've heard whole life is expensive, right? But billionaire, I mean, come on. That's when you know it's blown out of proportion to where it just used to be so ordinary that our parents and grandparents, Bruce, Dan, y'all's folks did what I said I started to do for my family was I just wanted to buy that kind of a whole life policy on my children. Y'all got policies from y'all's parents. It was normal. It was ordinary. It was, anyway, it's crazy how that's flipped.
Yeah. One thing that I think is important to call out, just mainly for listeners, was we were talking about companies, talking about dividends, things like that. It is important to understand, like, we are talking about mutual dividend paying whole life insurance companies, right? So these aren't your just standard run of the mill stock companies that are out there. There is a difference in how those companies are structured and then what they're able to actually produce. And especially with a lot of the companies that I know all of you and myself work with, these companies have been in business for well over 100 years. Some cases well even beyond that. And many of them have paid dividends in every one of those years. So even though dividends aren't guaranteed, we always have to say that, they are super consistent. And one of the things that I think a lot of people misunderstand about these whole life contracts is, even if they aren't let's say you have a whole life contract that's not structured in the way of infinite banking, the way that maybe we would set one up for someone, and it's strictly just a base contract, those things do amazingly well for customers over the course of their lifetime. Because of that dividend structure, because of the way they get reinvested back into the contract. In reality, on a lot of those, the smallest that death benefit ever is on those contracts is the first year. And then they just continue to grow and get larger over the course of that time frame. And they just become more and more and more efficient. So now you take that and you scale it into the way that we structure them for people. Well, now it's even better. But that just speaks to a lot of what we were just talking about. That's only possible when you have a company that's properly structuring how it invests in the bond market, how its financials are put together, right? All those different things weigh in and make those things possible for the course of infinite banking. But just to reiterate back to my main point was that we are talking specifically about dividend paying whole life insurance with mutual company.
Mm-hmm. So do you guys then have any lingering thoughts before we give the final punch, I would say, on this topic of owning whole life and maybe using it versus implementing this codified infinite banking concept as a lifestyle? And that's actually what I hope to use as a launch into the next topic I think I'll bring to y'all here. But yeah, anything else on that difference? But then let's talk about, okay, well, what is that difference? What does it mean to implement infinite banking? What is the difference?
Well, my final thought would be to tie up some of the things that we've been talking about is what I find interesting is the buy term and invest the difference or the rest. It's often buy term and spend the rest. And I've made this comment before on the podcast is with whole life, if you understand what's happening, you are buying a set term death benefit structured like a term, but out to age 121. And that additional money that is in the cash value is being invested by the insurance company. So you kind of are buying term and investing the rest. But because you are contractually, you have a contract where you're paying the premiums, you have a set way of actually doing the additional investing. Where if you buy term and invest the rest, you don't have a set way of doing it. You're relying on yourself either to do it yourself or paying somebody else to actually do it for you. I won't go into the whole background of this, but A.L. Williams was actually the one who coined this phrase, and it was because his father died prematurely and he had a whole life insurance contract. And I'm not afraid to say this. I think A.L. Williams was ticked off because he could have benefited from a big term policy for the same amount of money his father was paying for a whole life, so he got less death benefit. And so he was short-sighted and said, hey, the insurance company screwed me because I could have had a lot more money from my dad's death if he would have had a term policy. And his dad was using a whole life policy because he wanted certainty. He just happened to prematurely die. And so that whole thing has actually played into the downfall of whole life for a certain period of time, because people were saying, yes, look at these big bad insurance companies taking advantage of this man. They didn't sell him a term insurance policy and he could have had a lot more money. And so that is what actually happened, where whole life insurance, buy term and invest the rest, actually came down in the eyes of the American public. And it just so happened to coincide right at about the time where the 401k came in 1979. So now all of a sudden, people that never invested in the stock market were suddenly convinced that pensions weren't, you don't want pensions, you want to invest in the stock market and control your own destiny. And so they were like, yeah, this makes perfect sense. And really, it was a way for corporations to lessen their expense of retirement programs and push it off onto the worker. And they didn't even realize that they were being manipulated in that situation. So those two things came about at approximately the same time to actually bring down the value of whole life insurance in the American public. Luckily now Nelson Nash has brought it back into view because you can use it for a variety of things that it always had benefits from, and you can take the banking function control into your own life.
Yeah, I don't know that there's anything like the infinite banking concept that is addressed what I would say are the three main errors that the average American is making, which is either they don't have any guaranteed protection, they don't have what they think they have, or if they actually knew what they had, they would probably choose a different type of insurance, or they just don't have enough of it. I think that almost everybody fits into those three categories, whereas Nelson, of course, says that, well, if you implement this concept, because your need of finance is so important, is so high, you'll ultimately end up with more death benefit than you could otherwise have even been underwritten for from the onset. which has been a cool thing for me to watch. And Bruce, I mean, you've had policies longer than me. Dan, your policy that your dad got you, but I've seen the trajectory of the death benefits on our several policies and how they've grown over the past 10 years now. It's pretty cool. It's pretty cool to see that guaranteed protection going up because of the implementation of the concept. So how about from you guys? Anything else then that really separates infinite banking separate from just owning or even using whole life insurance?
I mean, I'll jump in, but not specific to what you were saying.
Jump in.
One of the things that I was just going to kind of respond to what Bruce had said earlier, where this whole concept, and I was guilty of it too, of buy term, invest the difference, and I was guilty of spending some of that difference, right? But I think the biggest problem that so many people have is they don't understand what investing really means and or is. They think that putting money into the market is investing. And quite frankly, if you don't know what you're doing, what you're putting it into, what all those risks are, what all the costs are, you're not investing. You're basically gambling. And you're just hoping it gets better. Where we're talking about something that's guaranteed, right? I mean, it's guaranteed to go one way. That's different than I'm going to buy some term and I put some money in the market. I'm going to hope it goes up. Well, we know those of us, I mean, I think all of us are old enough to have seen all these ebbs and flows within the market. It doesn't always go up. And then when you need it the most, is the market down? And then at what cost from there? Is it, if it's in a 401k, well, guess what? You've created a future tax liability that now you have to deal with when you need your money back. So, I mean, there's that, but going back to my original point of investing, how many variables do you control in that investment? If I don't control any of those variables, it's basically no different than going to a casino and putting all your money on red or all of it on black. There's no difference. You have to know what those variables are that you're entering into when you're putting money into some sort of an investment. And a lot of people just don't do that. I was guilty of it too. So I'm not, this isn't chastising anybody for doing that concept. I'm the first one to say that I did it too. But the key is education. The key is understanding. And once we get that understanding, that's where we can think differently. And that's where we can start to think about the foundational concept, which is, I think, where we're going next is, what are the foundations of finance in my life? I have this money flowing in. What am I going to do to control it? Because if I don't do anything, it's flowing right through. And that's how I ended up finding infinite banking, because I was 40 some years old and I was like, there's not enough here. Where did all this money go? I need to do a better job of controlling this. And that's when, thankfully God knocked on my, answered to prayer, knocked on my door. And here I am a few years later, and it's life-changing in terms of what it's done. So that being said, I think it's important that we have the right mindset and the right context of what some of these terms really mean when we think about buy term and invest the difference, when we think about just what is whole life and what is whole life through a mutual company, et cetera. So it's important to keep those things in context.
I'd love to ask a question. Now, this is the Jesse Durham podcast, but I had a guy tell me there's nothing guaranteed in life. When I told him what Rob just said, like it's guaranteed. Oh, there's nothing guaranteed in life, right? And so I don't know. I'd love to hear you guys respond to that comment for people. I mean, I think it's a relevant conversation, right? Because we're talking about whole life as a product and the value that it brings. Like, how would you respond to someone who's thinking, well, if I put my money in the bank, I know it's going to be there. It's always been there my entire life. I can get it. It's safe. It's quick. It's easy. How is this whole life thing you're talking about guaranteed?
I got chastised by a church who's actually a church elder for using the word guaranteed, because he was saying you can't say that. And he was also chastising me for using the word infinite. Me and another guy who was in insurance in the church, and we we're just like, okay. But I think he's going a little bit overboard with that. I don't think he needed to make those type of judgments, but you guys have any thoughts
Uh,
on
Well,
that?
I do, and I know Bruce does. I can see it
right.
on his face. So let me say thank you. Thank you, Brandon. Thank you, Dan, for sharing real life feedback from people that we just interact with, right? So I got thoughts, but you go, Bruce.
Well, I've dealt with this, Brandon, over my career, and those people are what they're trying to do, in my opinion, is they're trying to twist those words around so that because they can't formulate their own argument against their own feelings about inadequate feelings about this situation of instead of just saying, well, um, I really believe in something differently, but I can't explain why I believe in it. It's more emotional. So I'm just going to throw this out to put your your guard up. And the fact of the matter is, I know where they're coming from because there is no such thing as a guarantee when you're talking about mathematical guarantees. But this is not a mathematical guarantee. This is a social contract guarantee. So what they're saying is mathematical guarantees, like we know the US dollar can collapse. We know that all the insurance agencies or industry could collapse. We know society in general could collapse. So mathematically, we know that it could collapse. But what the guarantees, which by the way, you can only use that number in a highly regular or use that word in a highly regulated environment because lawyers who we have society have agreed to um, say that they are the people that develop these contracts, they will then say, according to society, we can use the word guaranteed compared to every other thing out there where you can put your money. So they're comparing the guarantees to everywhere else that society has agreed on where you can put your money. Nelson made this comment very many times when he said that you could always change tax law. Tax law is not a contract. You cannot change contracts unless society collapses. So unless that person can agree on the fact that yes, the only way you can't use the word guarantee is society collapses, then who cares where you have your money? It's a comparison situation here. So once again, I would say to this person, you're right. We can't mathematically say it's a guarantee, but from a conceptual society point, the lawyers have said we could use this word guarantee because we're not comparing it to math. We're comparing it to all the other places you could put your money. And that is a hard concept for people to agree upon, especially when they don't have a good argument of why they're putting their money in non-guaranteed places. You have to be a deep thinker to think about this.
Yeah, that's a good way of describing it, I think, Bruce, and that's really helpful. Like, because you could do that with anything. I could tell my wife I'm going to the store to buy groceries, but am I really good? I mean, what if I get, in a car accident on the way there? I don't really know if I'm really going to make it to the store. It's like if you start playing that game, then you can't, how can you even start communicating without making certain like generalizations or words to mean things?
And I'll say it to you in this way, Dan, just because you presented it in this way. The Bible does tell us, we'll say, well, I plan to go here and spend a year and hope to have gain, God willing. So just because you said that was in a church context that you had that interaction. I love what Bruce said, and that's what I had jump into my mind. So I feel like I could give you some biblical references, right? And for people that matters to, maybe it would matter to them. But let me hold that off for a second.
Hey, Jesse, by the way, I am religious, but I'm not biblical because I grew up as a Catholic and we don't study the Bible. We study whatever the priest tells us about the Bible.
Well, see there, I'm glad you said that, so I didn't have to say it for you.
So don't embarrass me in front of everybody by asking me about the biblical verses, because I've heard them before, but I haven't read the Bible. Well, I've read the Bible, but I mean, I haven't studied the Bible for each individual biblical reference. So this is good. I'm getting my Bible study today.
Listen, you're going to be in good company here. There's not a guy on here, and they know, they're smiling. I've already dug at them. It's something, biblically referenced. They know it's good fun. So I can, and I would like to. But here's what I thought of is, answering a question with a question. Because I'm like Bruce and this guy that you're talking about, I'm thinking, well, you know what? You're right. Nothing is guaranteed. But if we said, okay, I agree on that, let's go deeper. Let's think about it a little bit more. What percentage of Americans die? Seems 100%. Seems to be 100%, right? So with biblical references, there are two exceptions that I'm aware of, right? Enoch in the Old Testament and Elijah. So there you go, Bruce. But 100 out of 100 people are going to die. Well, if we can assume that, and I think that's a safe assumption, and there's this financial product that's older than the United States government that we can have contractually guarantee some financial aspect of our life, why would we not tap into that? I want to ask this guy from church or your guy, Brandon, out of how much you earned last year, the money that went through your hands, how much did you keep? Because the word Bruce said was comparison. It's a comparison question. And that's what I had pop in my mind is, well, compared to what? If we can talk about financial products, and if we can talk about financial processes, it seems to me that these life insurance, they've predated me. And they're probably going to last longer than my lifetime because 100 out of 100 die, right? And they've just been paying these death benefits all the while. They've been paying these dividends all the while. They've been providing this contractual right to be able to leverage the cash value of your policies and use that, and et cetera. So as far as guarantees go and what we can expect and rely on, to the degree that we can rely on anything, compared to what? If you can't say guaranteed or infinite, that's an interesting thought to why someone has an issue with infinite, probably just from their small thinking. And I mean that sincerely, not maliciously. Yeah. Compared to what? That's my question. All right, fella. Compared to what?
Yeah, I think that's really good, Jesse. And what Bruce, that's probably one of the better explanations I've heard before too. But when I try to think about it as, well, why is somebody going to object to guarantee, right? And I look at it as it's a straw man fallacy. Somebody is their thinking and their mindset, where they're coming from, has been challenged, and they're trying to defend where they're coming from a little bit. So they're entering in, well, nothing's guaranteed. So they're kind of distracting from the main point of the argument. And I think that should be a trigger for anybody to take a step back and say, well, in comparison to what? Why do you say that? Why do you think that it isn't guaranteed? What's giving you that indication? And I think that's a good place for us to be aware of when we hear those types of objections in general. And that's not just limited to what our topic is today. That's really in any level of conversation that we have. Whether that's a spiritual conversation, whether that's a financial conversation, whether it's even with our own family. If we're getting those types of objections, it should be a red flag to be like, okay, there's a misunderstanding someplace. Let's take a step back and ask some questions.
Let me tap back in. I'm not done. Thank you, Rob. I guarantee you, here's my guarantee. I guarantee you that the people that are saying this stuff probably fit into one or two camps, one or two categories. Number one, they either don't keep any money, they don't have any at all. Or two, excuse me, they're what you were describing earlier, Rob, which is speculating. These folks, they earn money. Where did they decide to put it that's superior to a whole life policy with all of its advantages? Or were they not probably just speculating? Rob said gambling. I could use either one of those. I bet you they're just speculating with their money or spending it all. Right? I bet you it's one of those two. That's what I would guarantee. Anything else? I'm gonna use this to launch pad to the next conversation. I'm here for the next hour. Y'all tap out if y'all got to tap out. Is there anything there that we didn't say about just owning whole life insurance and maybe using it versus implementing infinite banking?
Just to put a bow on this thing, the problem is that when people start using the word or start fighting you with the word guarantee, it's because they're starting to compare it to rates of return. And really, the infinite banking concept should not be compared to rates of return. It should be compared to what you would do with your money when you put it into a bank, so that you can take the financing in control of your life. And then, as Nelson said, it's the volume of that is like 34.5%. So I would challenge anybody that they think they could, get 34.5% of a rate of return in a investment vehicle. It is amazing. One of my mentors has a process now that he shows people. He takes their paycheck and he shows all the money that's flowing out of their control in the form of taxes, federal, state, Medicare, Social Security, then their 401k, anything else they might be sending money to. Then he shows that as a percentage. Okay, this is what you get to keep net wise. Now show me what you're financing. And he'll say, okay, you're paying $300 for this, $800 for this, $2,200 for this, blah, blah, blah. And then he shows that percentage, and it can actually get up into the 70, 80% of money that's flowing out of your control. And his statement is, what I'm going to do is I'm going to show you money that's flowing into your control, then money that's flowing out of your control. And my hope is I can get more of that money that's flowing out of your control back into your control. And that simple way of looking at things, by breaking down the money that's flowing out of your control, is something that both the federal government, the state government has figured out a long time ago. Is if we take that money away from them right away, they won't even realize it's flowing out of their control. And that is also why gym memberships or car dealers or furniture dealers, they ask you, how much would you like to pay every month? Not how much is the financing cost? How much can you afford to pay? And oh, by the way, we'll just have it automatically taken out of your checking account and sent to us so that you never see it. And so the American people don't feel the pain, even though they're getting death by 1,000 cuts. I challenge each and one of you sometime to ask your clients to get a paycheck stub. If they're W-2 employee, ask them to get a paycheck stub. I'm going to tell you 90% of them, and I'm making that number up from just anecdotal evidence. It might not be 90, it might be 95, it might be 70. I don't know, but I'm telling you, I think it's about 90% are going to tell you, oh, I never look at my paycheck stub. It's online now. I have no idea. I have no idea. So they have no idea the money that's flowing out of their control. And Rocket Money now has been doing advertisements for an app that you can actually pay them to show all the money that's flowing out of people's control. And people are just astounded that all this money's flowing out of their control. And the reason Rocket Money is doing it is because they know they're bringing value to the American people, and so they can charge for it. So just think about that. A company like Rocket Mortgage produced another company called Rocket Money because they knew that there was a problem that they could help solve. And that problem is money's flowing away from people, and they have no idea it's even flowing away from them.
Well, I'm not going to add anything to what Bruce said. I think you did put a bow on that really well. Let me ask you something then that I've been wondering about for a while.
So if you got value from this video on how to live and leave a lasting legacy, I would love to know exactly what your biggest takeaway or biggest question was down in the comments section below. Live and leave a lasting legacy. Have a great day. Take care.